Hello, this is Charmaine from Tick Finance, and I wanted to explain to you what lender's mortgage insurance is. So just say you go to a bank to buy a house. So you've gone to the bank and you want to buy, just say for this sakes, a $300,000 house. And if you ask the bank for all of that money, you'd be borrowing 100%. Now, banks in this country love up to 80%. So in this case, if you only borrow $240,000 to buy a $300,000 house, you're borrowing 80% of the money. No bank's going to lend any more than 95%, so keep that in mind. So 80% is $240,000. So you go to the bank and you say, we want to buy this house that's worth $300,000, but we only want to borrow $260,000. Now the bank's going to go, well, that's over the 80% mark. No problems at all. You look like you can service the loan because we've had a look at all your pay slips. But because we're lending you more than 80% of the value of the house, the government stipulates that we must have an insurance policy on that money that we lend you. So what they do then is they refer you back to the lender's mortgage insurance, and 9 out of 10 times it is a different company. There's only a couple of banks that have their own mortgage insurance companies, but most of them are out there and they're outsourced. And it's a bit like car insurance. So the insurers will then risk profile you guys. So they'll check to see whether or not you've had any defaults in the past, if you've paid off all your credit cards, or if you missed a telco repayment. That all comes up. It's called negative reporting, but that's what they do. So they risk profile you. And if they're happy with you as a client, then they go to the bank. Yep, no problems. We're happy to give you the insurance policy. And the bank goes, we're happy to give you the loan. And that's how mortgage insurance works. So the way that they calculate mortgage insurance is a little bit more complicated than that. It's done on what they call a logarithmic scale, which in a nutshell means they've got no friggin' idea how they do it. It's just calculated. The closer you are to this 95% mark, the more it is. On $300,000 at 95%, it's anywhere between $7,500 to $12,000, depending on the bank and depending on the mortgage insurance company, because they're all a bit different. So let's just say it's $7,500 on this. So they actually add that up to your loan. So your new loan will be $267,500, and that's what they will lend on. They'll pay the money to the mortgage insurers, and that protects you. It's a one-off payment. You only pay it once. You don't pay it any more than that, as long as that loan stays at that bank and you don't touch that loan, and then it's nice and safe. So the reason why they have mortgage insurance is so that we don't have what happened in America. So just say, for instance, if you got into some financial hardship and you couldn't make your repayments anymore, and the bank took the house back and they sold it for $250,000. On paper, they have lost $17,500 because you owe them $267,000 and they sold it for $250,000, which means they've lost $17,500. But because it's got this mortgage insurance already put on it, the mortgage insurers will pay the bank the $17,500. The bank would rather be at zero than negative, and then the mortgage insurance people come and chase you for the $17,500. And if you don't pay it back, it's a bit like a telco bill. They will put a credit report on you, and if they come chasing you, they will make you bankrupt. So mortgage insurance, to recap, is there to protect the bank. It's not there to protect you. You have to pay the premium, whatever it is, and every bank's a bit different. And as long as you don't touch that loan, then it's protected, and then the mortgage insurers will pay the bank if there's any loss after they've sold the property, because the bank would rather be at zero, and then they will come chasing you for the difference. So that's what mortgage insurance is. It's not there to protect you, it's there to protect the good old bank.